Well, first up, ratings agency Fitch has assigned 4 Nigerian banks with subsidiaries in Ghana a B- with stable outlooks. The banks are Access Bank, Guaranty Trust Bank, UBA, and Zenith Bank. According to Fitch, the banks are robust with strong buffers. However, they continue to contend with US dollar shortages, and the Central Bank of Nigeria's highly burdensome cash reserve requirement. Fitch therefore expects reform progress under the new administration, including the elimination of fuel subsidies and gradual liberalization of the naira. What are the implications of this rating? Dr. Benjamin Amwa, who is Senior Finance Lecturer at the University of Ghana Business School, joins us on Zoom. Good afternoon to you. Thanks for your time. So what does this mean for the banks, this B- with stable outlook?
Thank you very much. For the bank, we can look at it in two ways. We can look at the parent in Nigeria, which is the parent bank that more or less, has subsidiaries across Africa. We look at the 4 banks: GT Bank, Access Bank, Zenith, and UBA. Realize that is the parent's concentration of its investment in the sovereign instrument of Nigeria that is influencing the current performance, and the extent to which these banks are geographically, dispersed across Africa. What is rather showing from the report is that the performance of the Ghanaian subsidiary, i.e. the losses that some of the Ghanaian subsidiaries of these banks have made, is what we have negatively impacted on the group as a whole. So as the Nigerian economy picks up, these banks will have their books improved simply because of the strength of the Nigerian economy. The case of the Ghanaian banks or the Ghanaian subsidiaries of these banks are quite different from the current assessment from the parent level.
Yeah, and these banks are heavy weights, no doubt, here in Ghana, and whatever happens to them has an impact on our local banking industry because of their market share, right?
Absolutely, absolutely. So if you are looking at the contributions of these 4 banks in Ghana, then definitely whatever their position is per the exposures that these banks may have picked from their investment in Government of Ghana instrument will definitely impact on our market. But currently, the ratings that are coming from Fitch is more of an assessment of that of the parent. We should not also forget that the parents do have interest in all the subsidiaries across. So definitely, whatever happens to the parents will affect the subsidiaries, which will also affect the activities that the subsidiaries have on the Ghanaian market.
Okay, so Fitch notes that the banks have had to contend with US dollar shortages and the Nigerian central bank's burdensome cash reserve requirement, and so they have to fix that. And you point out that that is the parent company. Now the subsidiaries have to deal with another thing, which is debt restructuring, which has weighed on them. How do they navigate that?
Okay, so we have to look at it from this point. In Nigeria, the issue of the dollar and the naira is still an issue that the Nigerian government and central bank is working at. We should not forget that these subsidiaries in Ghana, from time to time, will need support from the parent, most especially when the central bank, Bank of Ghana, is calling for capital recapitalization plans, then definitely these banks will have to fall on the parent. So if the parents are not comfortable in terms of what is happening in Nigeria and across Africa, you see, the African economy is so fragile that post-COVID, most of these economies are trying to restructure their finances. So definitely banks that are operating on this continent are also exposed. So for these big banks from Nigeria, once they are affected in terms of the parents, then definitely they may also have some impact on the Ghanaian subsidiaries. So in the recapitalization plan that the Central Bank of Ghana is calling for, I believe that the parents who are in Nigeria currently for these 4 banks will definitely be impacted by some of the implications that the central bank's capitalization plan is calling for, and indirectly too, the experience of the parents in Nigeria will affect the operations of these subsidiaries in Ghana.
And so based on this, to what extent do you think these Nigerian banks will review how they operate here in Ghana, their approach when it comes to, for instance, lending and bond trading?
It depends on the philosophy of the parents of Nigeria, taking a holistic view of the African economy and which markets in Africa are promising. The example of Ghana doesn't speak well for the Ghanaian case because we have gone through debt restructuring and banks have suffered. The parent will want to look at other markets. Which market will promise them the more? And then they may want to put in more resources into such markets. For a market like Ghana, what a parent may want to do will just have to observe and make sure that they have their capital buffers intact for them to recover from some of these difficulties. In terms of what new to do for Ghana, is more of trying to stabilize their position in Ghana. To rake in more income, they may have to look at other markets that have promised higher returns than what Ghana currently presents to them.
All right. I appreciate your thoughts this afternoon, Dr. Benjamin Amoah, Senior Finance Lecturer at the University of Ghana Business School.